Hello and welcome to KYC, a show designed to give regular investors powerful, actionable insights into the fundamentals of a single NSE-listed company every day. Well, today we're talking about Electronics Mart India. This is India's fourth largest consumer durables and electronics retailer in India. Well, it's largely based in the southern regions, southern India, and it just focuses on a diversified product offering across about 100 brands. Well, Electronics Mart also has, while it does have stores under its own brand, it also has several others in terms of comprising of more than 8,000 SKUs across different product categories. Now, this particular company has come to the fore over the last few years, even as we see takeoff in retail in India. And considering we do have a lot of listed retail players, but none in the consumer durables and electronic space, which does make Electronics Mart a very, very unique, listed entity at this point in time. Now, let me tell you about how things have fared as far as its presence in India is concerned. So, firstly, it has about 178, MBOs, that's multi-brand outlets. This is followed by about 13, exclusive brand outlets. And as I've said, that it has about 8,000 SKUs, and it has current retail business area of about 1.69 million square feet. A lot to talk about, but I reckon that it's gained most of its tractions through its multi-brand outlet, because that's where it's built itself out. Of course, I would say the private space, it does have peers in something like a Chroma or a Vijay Sales. But given the fact that its presence and dominance is more towards the southern India, it's also making a little bit of headway towards the northern India, in some markets, which would include, the NCR region and Chandigarh and so on and so forth. But in terms of store ownership, again, this is another crucial one to keep an eye on, because it gives you an idea about how many of these stores it owns and how many of these stores it has leased out. So it does have about 11 stores which it owns. About another 137 leased out, and it also has about 12 which are pre-owned and then leased. And so it's certainly a very interesting mix. Do remember that when a company actually owns a store, it doesn't need to shell out rent for that particular property, and that always works out to our advantage. Well, case in point, of course, DMart is the other one. Of course, it doesn't operate in consumer durables and electronics, but it's certainly an advantage. It does seem like at the moment, though, majority of all the stores that the company runs currently, about 137 to be precise, are leased. Well, with that, and on that note, let's shift focus to all the parameters that we are talking about. Now, as we always do, we assess the company based on the fundamentals of what the company has done over the past few years, and take it forward from there. So we do address your income statement, not just revenues, but the income statement as a whole. We talk about the balance sheet as well as the cash flows, and along with that, we also talk about the revenues return ratios as well. Moving on, we also have shareholding, street credentials, valuations, and street coverage. So, without any delay and a further delay, let me get in my colleague Mahima, who's also going to join us to give us an idea and shed more light into the company and what the company has done so far. So Mahima, good morning and thank you for joining in. Let's start as usual by talking about the income statement. How have the revenues and profitability turned out for this company?
Right, Agam. Good morning. In terms of revenue, the metrics we've given a thumbs up to this metrics, because overall, if we see the revenues so far in terms of 3-year CAGR, they've grown by about 25%. EBITDA has grown by about 30% CAGR in the past 3 years, and net profit has grown at a CAGR of 46%. In terms of margins, the margins have taken a slight hit when it comes to 9 months FY25 number. They've come down to around 6.4% versus that of 7.2% FY24. So we'll have to wait and watch out as to how FY25 overall settles when it comes to margins. But revenue has grown at a decent CAGR. In terms of the split, the 42% of their total revenue comes from mobiles, 45% comes from large appliances, and small appliances and IT contributes around 13% to its total revenues. In terms of key operational metrics, same-store sales growth was at 3.8%. This is of course 9 months FY25. The net retail sales per store was down by about 15 odd %. Average ticket size was down by about 1%. And bill cuts were up by about 12 odd %. So overall, Agam, it's a thumbs up since 3-year CAGR paints a good picture. But in terms of the operational metrics overall 9 months as well as Q3 are a bit under pressure because of the consumer demand sentiment that has been the case so far in the consumption space as a whole.
Right. Well, I just want to make a very quick point on margins. Well, so this is a retail company, and naturally we're expecting margins to usually not be considerably high. But I'd still want to take the case of perhaps something like a Trent, where the margins are standard around 15–16%, and I know the apparels business cannot be compared to that which is into consumer durables. But in overall margins profile, and in general, again, retailers who come through and run these businesses, their margins are short. But it does seem like Electronic Mart's margins is towards that lower end of that range. So it'll be very interesting to know whether or not there is further scope in improving margins going in. And I'm just making this point because we're in fact talking about the income statement. But as Mahima has pointed out, say for that, we're actually looking at some strength coming in over the last few years. I'll talk about the balance sheet, and naturally, given the fact that you do see such strong operating metrics, you see such strong profitability, well, we will have accumulated profits on his balance sheet. So its net worth stands at around, well, nearly 1,500 crores by the end of the second half this financial year. And this is, of course, also moved up as compared to FY24. If you consider the gross debt, that has also increased a little bit. And, well, cash in bank, I reckon, stays the same. Well, we were on the fence of whether or not we should give this a neutral rating, and we were considering a neutral rating because its gross debt has moved up. But if you consider the gross debt with respect to its accumulated profits, that is the net worth, well, it's still not that high, which is why its balance sheet is still looking like it's in a strong place, and hence we're going to give this one a thumbs up as well. So that's as far as your overall net balance sheet is concerned. But Mahima, let's talk about the cash flows too. How do they look like? Right.
So with respect to the cash flows, Agam, cash flow from operations has remained strong. In FY24, it stood at around 330 odd crores, but that has improved to 358 odd crores in the first half of FY25. For net cash flows, if we see, FY24, it was a negative net cash flow of around 118 crores, but that has improved to now a negative cash flow of 37 crores, which is why we've given a neutral rating to the company, because the net cash flow is now improving, every year, which is why since it is still in negative, we've not given it a thumbs up, but since it's improving, we've given a neutral rating when it comes to the cash flows.
Right. And I'm going to wait for a further judgment on this particular company, because I reckon that your year-end numbers for cash flows as well are a little bit more important, and it'll give you a better idea of how things have panned out through the course of the year. But as Mahima said, that we are looking at improving metrics. So that said, let's talk about the return ratios, because that's which will tie up some of these income statements. And as far as return ratios are concerned, firstly, they're not at the desirable level. If you consider the return on capital employed, you prefer a 20% return on capital. At the moment, it's closer to that, and there's been an improvement over FY23. So it's going to be a good one, but because it doesn't make the 20% mark, it's a neutral. It's the same for ROE. ROE actually has come off quite a bit from 2022. From 17.4% all the way down to around 13.4%. So this is another reason why we don't want to give it a thumbs up. And we're going to go with the neutral here, because we are looking at some amount of deterioration in return on equity specifically. So it's a neutral rating for return ratios. And now that we are done with your overall income statement, your balance sheet, as well as cash flows, and assessed it with some of your return ratios, let's move on beyond these financial statements and talk about shareholding. Mahima, what can you tell us about this?
Right. So in terms of shareholdings, again, Electronic Marts India is a well-held company because promoters are still holding around 65% of the total equity. However, that has gone down from around 78 odd percent in September 22 to around 65% now. That is in December 24. In terms of the FI's holding, that has increased to 9.2%, which was around 8.8% in September 24. But FIs have significantly increased their stake from around 2.5% in September 22 to 9% in December 24. In terms of DIs, the stake has reduced as compared to September to around 17.9%. But DIs have also, over a period of time increased their stake in this particular counter from 7.5 in September 22 to around 17.9 in December 24. And lastly, public shareholding has gone up to around 7.6%. Public shareholding has come down a bit from around 12% in September 22 to around 7.6% in December 24. But overall, since promoters are holding, over 65 odd percent stake in the company, it's a well-held company, and which is why we've considered giving a thumbs up when it comes to the shareholding pattern of the company.
Yeah. Yep. Okay. So let's talk about the price action for the share price now. And well, it's not been a desirable one. Look, we must acknowledge what's happened in the last 4 days, or 4 months, 4.5 months actually, if you consider February too, that the mid-cap and the small-cap space particularly has taken quite a hit. Well, from October onwards all the way to mid-February now, we have seen somewhat of a correction which has actually played out very, very poorly with respect to a lot of your portfolios. And I'd reckon that the size at which Electronic Mart is in terms of its market capitalization, it is going to be susceptible to this correction along with the rest of the market. That said, the decline on a one-year basis is by as much as 38%. Now, this is not the best kind of return, even on a relative basis with compared to some of your other peers in the mid-cap and the small-cap indices. Well, there has been a little bit of an outperformance as compared to Electronic Mart, which is why it's not the most desirable of returns so far on a one-year basis. Calendar year to date is also when Electronic Mart is down around 20%. And if you just consider the returns over 5 years, well, the returns have not been good. It's not been a multi-bagger, as in it hasn't even doubled over the last 5 years. In fact, it's giving you half the returns of your expectation of doubling over the last 5 years. So in terms of returns, well, it's certainly not been a great one, which is why we will give this one a thumbs down. But I'd reckon that if you don't have returns, it does bode well in terms of valuations. But let's find out with Mahima. Mahima, what can you tell us about that?
Right. So, Electronic Mart's valuations with respect to the 12 months trailing PE, it stands at around 27.6 odd times. Now, Electronics Mart India does not have, a listed peer per se, but it does have competition from the unlisted space, when it comes to Reliance, retail, there's Chroma, there's Vijay Sales, which gives it competition. But with respect to the valuations, the 12 months trailing PE, as I mentioned, is 27.6 times. It goes to around 29.2 times in 2025 as per Bloomberg estimates, and 2026 it goes to around 23 times. So not a significant dip when it comes to moving from 27 times to 23 times in 2026 as per Bloomberg estimates, which is why a neutral rating is something that it's called for. However, in the consumer durable space, if we compare it to, although they are not like-for-like peers, but, the peers that are present in the consumer durable space, that is, your Blue Star, your Voltas, etc., are trading at a much higher P. That is also one of the reasons as to why, we've given a neutral rating when it comes to valuations part, Aga.
All right. Well, there you have it. That's, coming down to what we were talking about, well, valuations. I'll finally sum it up with what the analyst community is making of the company, and they're all positive. So we have about 6 analysts covering the company, and all 6 have a buy rating on this, and with an upside potential of about 47% from current market levels. What we are seeing here is, well, in general, that the analysts are expecting a little bit of a recovery from current market levels based on the fundamentals that we've seen. And which is why we will give this particular aspect a thumbs up. With that, let's talk about how things have fared in terms of all the parameters that we've spoken about and what is the overall total rating for the particular company. So, it's at least as far as your performance in terms of your revenue growth, your balance sheet so far, cash flows, return ratios, all very, very steady over the last few years, which is why it's a thumbs up, at least for the income statement and the balance sheet. We're looking at a very strong shareholding. We have good street coverage and good anticipation of an up move. Well, street credentials, the return that the company has given, the share price has given, is not, not the best so far. But again, fairly neutral in terms of valuations to fairly reasonably priced at the moment. So taking all these factors into consideration gives us a total rating of around 5.5 out of 8. So there you have it. That's the rating for Electronic Mart. Now I believe that we do have the management of the company standing by. But before we go across to the management, I want to very quickly talk about the SWOT analysis. So in terms of strength, we're looking at the South cluster growing at a fast pace, and there's rapid store expansion, so obviously going to play in favor of the company. In terms of weaknesses, same store sales growth still needs to see a little bit of a pickup to have a meaningful impact on your future outlook. And of course, at the moment, the entire environment is soft with respect to demand. So that's not going to exactly be a tailwind for the company. What about opportunities and threats, Mahima?
Right. So in terms of opportunities, the right product mix and competitive pricing is something that will bring them an edge. Exploring more into quick commerce and e-commerce is something that will also bring in a lot of opportunities. And exploring new geographies, because right now they're more focused towards the southern markets, will bring in a lot of opportunities. And in terms of threats, there might be, mobile life cycles are kind of increasing, which is why, the customer repeat segment is something that is, a threat. In terms of inventory being piled up due to technology changing very fast could be one of the threats. And competition, of course, is pretty high when it comes to, although from the unlisted players is very high, and which is, one of the threats to consider.
Okay, well, no better time then to bring in the management of the company. We have Premchand Devarakonda. He's a CFO at Electronics Mart India, who joins us on the show. Premchand, good morning, and thank you so much for taking the time out. Interesting times, and while you have seen so much growth over the last few years, it does seem like the overall demand environment in terms of consumption for India, and especially the markets that you operate in, are looking at a little bit of moderation. What is your own assessment of the current demand environment?
Thank you very much for having me on your show. Last 2 quarters was little disappointing because there is a lot of maybe because of the high food inflation, so the disposable income of the customers has gone down, as well as there is stiff competition in the markets where we have been operating. And when the competition increases, obviously we have to pass on additional discounts to the customers. So maybe these are the reasons, and also moreover, so the average selling prices of certain categories have come down drastically. That means by 30% in certain categories as compared to last year's. So all these things contributed to little upset in this in the couple of quarters. Otherwise, when we looked at the quantity growth, it was quite promising. And since 1st February, again, the situation seems to be improving and promising. And we are quite optimistic that in the upcoming quarters, we'll be back on track in all respects.
Right. Mr. Devarakonda, Mahima also joining in. With respect to the margins, I wanted to understand that, 9 months FY25, they stood at 6.4. But this quarter, they had come down to around, 5.2% when it comes to the EBITDA margins. So I want to understand, because your margins have been, over 7% as well. When do you expect the margins to recover to the levels that they were, and what will be the levers that will lead to the margin growth?
See, again, the margin growth depends on the product mix. So normally what happens, there are certain categories like large appliances, IT and mobile, and then the small appliances. So if the product mix changes, normally it changes in the first quarter where the movement of white goods is higher as compared to other categories. That means the contribution coming in from the sale of white goods will be better. So if that trend continues, that means if we have extended summer, so obviously we will have the improved margins. But the Q3 was an exceptional quarter. So it will happen once in lifetime. So hopefully, so that trend may not be there in future. So that scenario may not be there in future. And uh, till, I mean, for the first 9 months, we were at 6.4% of the EBITDA. So that might, even this year we might end up at 6.5%. But from next year onwards, and we are optimistic that we are able to sell the attachments along with the products. So those things will definitely contribute to the better margins. Coming back to by end of next financial year, we might come back to the 7% EBITDA margins.
Premchand, I also want to ask you about how you all are going about when it comes to ownership of your stores as compared to leasing of stores. Is this what you all have done so far going to continue, or are you also seeking to ideally also own few more stores in a ratio? Do you think that this ratio could change going forward, or does that depend from situation to situation?
See, it is on a case-to-case basis. If we get a good deal at the good location, we might look at the option of acquiring the property. Otherwise, yeah, our strategy is to keep the ratio of old stores and the new stores at 1:6. So that might continue, not even 1:6. It is, it's around that. So we will maintain that ratio in future.
All right. And in that case, if you could also very quickly tell us about your store expansion going into FY26. Do you guys have some numbers in mind?
See, for next year, we are planning to launch another 30 stores. So out of which 6 stores will be in NCR and the remaining stores will be in the South Cluster.
And will these be MBOs, EBOs? How will the split come through?
See, MBO is never there in our master plan. So MBO is a goodwill gesture that to maintain the relationship with various brands, we'll launch the EBOs. It's right. CBOs. So when our plans are always about the MBOs. So when we talk, it is only about MBOs.
Okay, Premchand, we'll leave it at that. Thank you so much for joining us and taking us through what we can expect from the company going forward. Well, there you have it. That's the management of Electronics Mart India telling us about all that we could, they could expect coming through over the course of the next few quarters. There's expectation of an improvement in margins based on the change in product mix, which would, of course, favor higher margins. But it's going to be a wait and watch. We do know that the demand environment could see a little bit of an improvement as well, given the kind of current inflationary challenges that we do, in fact, see facing the consumer. But on that note, I'm going to thank Mahima also for joining us, and also, well, that is the end of this edition of KYC. But stay tuned to NDTV Profit, and we'll keep bringing you more.